Welcome to Self-Made Millionaire Tips. I'm Colin Plume, CEO of Noble Gold Investments and founder of My Digital Money, and I'm sitting here with Warren Burzak, friend, commercial real estate agent. We've known each other for 20 years plus, and we're talking commercial real estate. And I did a mistake in the last podcast. Because it said here he's the top agent with Leaf in 2018 on his paper, but actually he's been the top agent since 2013. So that is a big difference. Closed over $2 billion in sales, specializes in multifamily, retail, land, closed a lot of deals, and knows a lot about commercial real estate. And we ended, and then you sort of gave me a little sneak peek of a deal. We were talking about long escrows. And you said you had a deal in escrow for
4 years.
4 years.
4 years.
Can you? I mean, talk about really having some patience on a deal.
I'm sure this is a world record.
It could be, yeah. Tell us, about this deal. Why it took so long to close. Obviously, it's unusual for any deal to take 4 years.
Sure. So it's a deal in Long Beach. Long Beach is kind of was founded amongst a lot of oil. Mm-hmm. So it's a development site for a hospital. They want the piece of property. It's behind their
current hospital.
Their current hospital.
Okay.
And we had a lot of multifamily people that are interested, a lot of different people interested for other uses, but they were the top bidder. But there's a lot of, not so much contamination, but there's a lot of, trying to think of the word, but basically like old oil wells. Mm-hmm. So they need to be capped properly and stuff has to be done.
So this was a site that they actually would pump oil out of. This wasn't like a gas station.
Correct.
Oh, wow. Okay.
Yeah, they would take oil from 5,000, 10,000 feet below.
Oh, wow.
The surface.
Okay.
So Long Beach is covered in these oil wells. And so this property, I think, has 6 or 7 of them. And so it's just there's a lot of government oversight and hurdles. So it's taken 2.5 years to clean up, and we were in escrow before that, and
wow.
And more time after it was cleaned up to close. So
and the
long process.
The seller of the land paid for the cleanup.
Yes, I think there will be some expense borne by the state, and that's money from the sale of gas. Mm-hmm. Like one of the reasons California has such high gas prices is the extra $1 or so that the state takes for roads or for contamination. Mm-hmm. There's a super fund to pay for cleanup sites. So I'm sure ultimately the seller pays part of it, but I think the state and maybe whoever was there before, the oil company that was there before, potentially is paying for part of it as well.
Wow. And what do you think the cleanup cost approximately?
I think they've spent close to $7 million.
Wow. That's amazing. That's an incredible sale. And the buyer and this, was there any incentive? I mean, they had to clean. Any of the buyers would have required this, so they were going to be in escrow for a long time. So they had to bite the bullet and just kind of ride it out. Do you think with the market changing, they did better by selling it 4 years ago than if they would have sold it today, or do you think it's sort of a wash at this point?
I went into escrow pre-COVID, so the market picked up after COVID, maybe within 6 or 12 months after COVID. So it might have been a wash. They might have done better selling it then, but
it's hard to know at this point.
Yeah,
it's hard to know. Wow, that's a long escrow. I'm sure. I mean, and I think that's part of being in commercial real estate and in real estate in general, people don't factor, how many hours you must have had to deal with this escrow for years and years. As much as it's probably not a lot of work, there's probably just stuff that comes up that you have to deal with, right? It wasn't like...
Yeah, any escrow, like I said in the last interview, that the amount of fires you have to put out, like this is one example of a transaction that had a lot.
Yeah.
Fortunately, there was a team of people, and I was just one small member of the team. But, there's just deals. There's always things to deal with, always you think you've seen it all, and there's something else.
Yeah, no, that's true. And we had a few deals like that, too, that we'll get into on another podcast. We had a very interesting deal that we closed, but we'll get into that at a later time. So, Self-Made Millionaire Tips part of the show is not only finding about entrepreneurs and their story and how they became successful in Millionaires is where do people, where are people investing? And, there's all the traditional markets, stock markets and mutual funds. And then there's a syndicating deals. I'm an investor in apartment syndications and other deals. But people aren't always aware of what these things are, and maybe kind of break down comparatively to, let's say, like if you want to invest into a REIT, like what are the benefits or reasons someone would want us to buy a syndication as opposed to just investing in the stock market, for instance, with a REIT, which is a real estate investment trust, which is another way to invest into real estate.
So I would say generally the vast majority of people that are buying into a syndication. So just for those of you that are not familiar, when a property gets bought, either someone could buy it themselves or maybe a group of people are buying a property. So syndication is essentially there's a company or a person in charge that basically is raising the money and overseeing the process of purchasing a building. And sometimes they're involved with running the property. Sometimes they hire a third-party management to oversee the property and run it. Generally, I would say the vast majority of my deals, so I've got about 25 deals that I've syndicated. The vast majority are people that are interested in investing exclusively in real estate. Very few of them are stock market investors. Mm-hmm. They've chosen, for probably the similar reasons to me, I'm just not a big stock market guy.
Right.
I don't like the fluctuation in the market.
I remember years ago you told me that I think you sold all your stocks at some point, right? You sold a majority of the stocks that you had.
Yeah, in the run up to 2008, I had, $400,000 approximately invested in mutual funds, gold, not just particular stocks, but mostly mutual funds. And the market tanked, and I lost a bunch of money, and that just left a real bad taste in my mouth.
I'm done with this.
Yeah. So after that, I started, with my retirement account, and then ultimately buying buildings myself with partners.
So your SEP IRA, you've invested into apartments also.
All of the funds in my SEP, I've got some in cash, but all of them are invested in apartment buildings.
All of it's invested, and it's so a lot of people aren't even aware that you could put syndicated apartments or deals like this. A lot of times people think again that you have to invest all this in the stock market. But you can actually buy a part of an apartment building in a syndicated deal in a self-directed IRA, right?
Yeah, just like you do your gold, like clients are coming and investing.
Correct.
With precious metals. So yeah, same.
So for those who want to start syndicating, what are the basic requirements and how much money at a minimum do I need to invest in it?
So every company that provides investments to invest in has maybe $50,000, $100,000 general kind of minimal investment. For me personally, I've started at $25,000. I actually have a couple of people that I've allowed in that are smaller than that. And the reason being, I want to help people create kind of like passive income for their retirement and for their kids and all that sort of stuff. So probably 99% of them are over 25,000. I've got some people that have put in up to $1 million in a transaction. So it really just depends on what their comfort level is. But a lot of people put 25 or 50,000 into each one. I'm big on diversification. So if someone's got $250,000, I would say put that into 5 deals at $50,000 and $50,000 chunks.
And any other requirements?
Anybody that's raising money, if you're raising money from other people, they've got to be accredited. The investors are supposed to be accredited. So that means the two big basic ones, they've got to have a certain minimal net worth, which I believe is $1 million, besides their home, so like investable assets, or they have to make over a certain amount of money. If you're single, I think it's $200,000. If you're married, it's over $300,000. So those are the main things that would basically say that you're capable of investing. There's other stuff as well, but those are the main two.
Okay. Do you accept foreign money?
I I do. I have not, but I've had conversations with investors that are foreign citizens. I was born in South Africa, so like my family has family friends that have assets. They're, people live in different countries, not necessarily South Africa. They have income and assets that they'd like to invest. So I've had conversations with people. The big thing is you have to pay taxes, obviously, in the U.S. So if they're a foreign entity, they have to form a U.S. entity to invest.
And then, so assuming I go in, put in money, what do I expect? Do I expect a monthly dividend, a yearly dividend, or?
Sure. The vast majority of people that do what I do, they do quarterly distributions. So basically, you put in $100,000 and you'll get, let's just, for easy numbers, say it's a 5% return on your investment. So you get $5,000 a year, basically $1,250 a quarter. That would approximately be how it would work. So each quarter, the people that do the syndication send you a report, they send you a distribution.
And that fluctuates. It's not always.
Yeah, it depends on the return of the property. Generally, rents go up. Right now, interest rates are much higher. So if you're in a syndication that didn't do a purchase or a refinance in the last couple of years, there is the potential that now you've got to refinance at a higher interest rate. So if that's the circumstance, you could, in theory, make less for whatever period of time where rates are higher if you have to refinance. But yeah, generally it's like my stuff. They kind of start at 5 to 6% depending on when they're purchased, and as rents go up over time, they should, in theory, go up.
And there's different types of syndicators, right? I mean, there's syndicators that will buy a really dilapidated building that needs a lot of work, and they will fix it up. And so just rents are $1,500 and they think rents can go to $2,000 or something if they make the building look better. So that's one way to buy, is they look at these buildings and go, okay, in the future, the rents will be much higher. Then another way to do it is just buy a stabilized deal. What are some of Warren? What is some of the things what are your, like, I won't touch this building if it doesn't? What are the requirements that you're sort of looking for before you even? And I know, let's not downplay the biggest part of this whole syndication is finding property. The right property is, and I know you're very selective. How much of that plays into this? Is it hard to raise money, or is it just hard to find deals? Like,
It's much harder to find deals.
Yeah,
it makes sense. Generally, I can raise money in an afternoon.
Yeah,
given that I've been doing it for a while. So you're right. There's different models. So the guys that, in going back to your question about return, so the stuff I buy is stabilized generally. Sometimes there's a little bit of add value. I've done some buildings that I've purchased where I can add a accessory dwelling unit, an ADU, and add 1-3 units to a property. So that's some add value technically. But for the most part, the stuff I've bought has been kind of chugging along. Someone else came and did some of the work already, or all the work already, fixing up the building. And the reason I do that is because this is not my core, like, the other podcasts we talked about, primarily brokerage is my business. So, it's become probably 50-50 today after the last 15 buildings I bought since COVID started. But before that, I didn't have the wherewithal to kind of operate a reposition business where someone goes in, buys out tenants, and there's like a, say, 1 to 2 year period where they're fixing up the building, getting out the tenants, all that sort of stuff. So if you invest in one of those deals, generally you're not cash flowing for the first year or two. So it just depends on what kind of investment you're investing in. So yeah, there are a bunch of different models. The most intense is that kind of renovation, reposition play. And then the least intense, I would say, is kind of what mine is, which is more buying stabilized assets. But there's a lot of stuff in between. So sometimes they're buying an office building or a retail property, and they want to, kind of reposition the property to bring in a different tenant or a different tenant base. So you can buy an office building like the one we're sitting in, spend $5-10 million fixing it up, and then generally get better tenants and higher rents. And it's just a much longer term process. So it just depends on what kind of property you pick. There's guys that buy industrial buildings where there's one tenant. There's really nothing to do.
Right.
And then that tenant leaves, and they bought it because they saw that the existing tenant was paying $1 a foot, and they can get $2
$2 out there.
So
yeah.
there are a lot of different models you can.
Yeah.
You can go.
So you're looking mostly stabilized properties in LA. What class, because there's different classes of buildings that you could buy. What typically have you focused on in terms of the buildings that you're buying?
B and C properties.
Okay.
The reason being is they're not building any more kind of rent control B, C type stuff in LA. Everything that gets knocked down and built is Class A.
Right.
So there's like an infinite supply. Right there. Every year they're making 10,000 units of new supply.
So they're building Class A, and then there's these B and C buildings that they're never going to build again.
Yeah, so the rents, I think, are more secure, more stable.
Got it.
So like in a market like today where you're seeing more and more brand new inventory come on the market, those guys are having to offer concessions because the rental market is weaker at the high end.
Right.
Whereas in my B and C properties, I don't have to today.
Right.
It's just as strong as it was 12 months ago.
Right.
So I'm not competing with, and if there's an economic shift, generally the guys that get hurt are the higher end tenants. Mm-hmm. And so you'll see the rents for higher end, they don't generally bring down the rents. They generally offer concessions.
So they get free rent, or they do something else to.
Yeah, no deposit or free rent, or
right.
several months of free rent, or whatever it is to get people in the door. So, that's always 5,000, 10,000 units every year coming online.
Right. And you're not competing with them.
Correct.
Yeah.
And generally when people build new buildings, they're knocking down old buildings. Not always. Sometimes they're vacant pieces, or there was something else.
Sure.
Some other type of property on the building, on the land before. But if they're knocking down old buildings, that only makes my stuff
more valuable.
Yeah.
And what are apartment rents? What are you seeing apartment rents for B and C buildings on the market? What's your vacancy right now? What's happening kind of in this regional market? What are you seeing out there vacancy wise?
So vacancy across the LA area is in the 3s.
Okay.
Stuff that's newer, it can be 5% to 10%. So I was just doing one of my clients is looking at stuff in Woodland Hills, Woodland Hills, California. And so that market, they upzoned all of the land so that you can build a lot more units.
They're building a ton out there.
Yeah. So the regular kind of the stuff that I own in that market is 3.5% vacancy. My portfolio today is probably 1% or 2% vacant. Wow. But the newer stuff is running close to 10% vacant. Yeah. And offering concessions. Right. So you can definitely see it on the higher end of the market, the stuff that basically has, brand new in the last 5 years, lots of amenities within the property. Kind of, they're all tripping over themselves trying to offer something. Pool, gym, dog runs, places to wash your dog, like all kinds of stuff.
Right. You need it. You gotta have it.
Yeah. Who wants to clog their own
Fairlane's like, yes, I like those buildings with her dog.
And you can wash your dog down the hall in the communal dog wash and clog that drain. Why clog your own drain?
I was talking to a guy that runs a landscaping business, and he was talking about he takes care of some of the properties, and they've been going back and forth on real grass, fake grass, because there's this new thing with fake, but then the fake grass, it's harder, then you're just washing the poop down the road, I guess, so to speak.
Yeah, or even the smell.
The smell.
I have a couple of buildings where the prior owner put fake grass in, like in front of the building. So everybody that walks their dog in the neighborhood.
They just drop it.
Yeah, it's not even number 2, but just number 1. It's just, it always, and if the rain comes, great. But otherwise, like in the summertime, you got to wash it down.
Yeah. No, it's not. It's not great.
Is this a good investment during recession?
So there are very few deals getting done today in multifamily. So I invest in my stuff, but I also invest in a lot of other people's stuff, and I'm not seeing any deal flow. They're very.
How much do you think it's down from 2 years? 2020 during the pandemic was
I think
decent, right?
I think apartment sales across the country are down at least 70%.
Wow.
And syndicators
are on a lot of vacations.
It's very, very little volume is syndication.
Yeah.
Because it's driven by interest rates and returns. And even my stuff, like if I was buying at 5 or 6% before, today it's 1%, 2% return. So there's no point in investing to make 1 or 2%. It's not worth the brain damage or the risk for that. So there's very little syndication business today. So are there opportunities to invest in? Very few. And even if there are, it's not necessarily something that you want to invest in. Maybe it's got a very long turnaround. If you're investing for cash flow, probably not something you want to invest in. So that model is definitely on the sidelines today.
Yeah, the volume is down, and I think it's until and I've been saying this for a while, I do think interest rates come down at the end of this year. I think we're going to see a little bit of a pullback, which I think will create some volume, a little bit of volume. But I don't think interest rates are going back to the 3s anytime soon. I mean, what are your thoughts?
Yeah, I think interest rates, it's probably more like a 2-year thing. I don't know if inflation will come down enough by the end of this year that the Fed will be inclined to start reducing. Mm-hmm. I definitely think the economy is slowing down a little bit in certain segments of the economy. But generally, my business is driven by bank loans, and the banks have become much more conservative.
Right.
Today, you're seeing First Republic get bought by Chase.
Right.
So you're seeing more consolidation, which we saw in 2008. And there's plenty of banks that will lend, but their requirements are much more stringent today. They want larger down payments. They want reserves. They want your banking relationship. There's just aspects that a year or two ago, you could get a loan, no problem, right. 30% down, 40% down. Now it's 50% down. So that leverage alone changes the syndication model.
Absolutely. Because
the vast majority of syndicators, their business model is not necessarily the cash flow. They want to fix up, do whatever, and sell because that's when they make their money.
Right.
My model is a little different. It's for long term. So 20, 30 years from now, we'll probably still own the buildings. And I've invested a substantial amount of money alongside my investors. So I'm not, my business model is not churn it as quick as I can so I can make my money on the back end. That's not the model I have at all. So, but other people I invest with, that is their model sometimes. So
they want to hit an internal rate of return 3 to 5 years, and then they're going to flip it because that's where they really make.
They get 20 or 30 or 40% of the profit
off the sale. So they're motivated to and listen, the investor still makes money, mm-hmm. but I think that it also creates a problem for the investor because a lot of investors that have high net worth, they don't necessarily want a big sale out in 3 to 5 years, right? I mean, some people they just want cash flow.
Yeah, the bulk of that's what I want.
Right.
So generally that's who my investors are. They're looking for passive income for 10, 20, 30, 40 years.
Right.
As opposed to, okay, now I get my money back. Now I got to pay capital gains,
right.
or I'm forced to go into something else.
Now I got to find another deal.
And that's, for the most part, I invest IRA money with other companies because when I get back the money, number one, it's not taxable.
It's tax deferred, right.
So that model doesn't bother me as much as
right.
having to pay regular
capital
income
gains.
taxes.
And
capital gains. So
that makes sense.
It just, it's like everybody has their different, going back to your original question, do I invest in stocks? Do I invest in mutual funds? Do I do precious metals? Everybody's got their thing that they invest in,
right.
and what they've been successful with, and most people generally stick with what they've been successful with.
Yeah. I was talking to somebody about the gold business. They're asking, tell me about the gold. Who should I buy from? And I always say, like, you want to buy. You're not going to buy a taco at McDonald's, right? Like, you're in real estate. I'm in the gold business. I invest in real estate too. I'm diversified, but you want someone that's living and breathing that investment to be in charge of your money. Last question, kind of wrap up syndication. A big part of syndication on some of your properties, you've refinanced and pulled money out. Talk about how that works for the investor. Do they pay tax when the money comes out? how that's worked. Give me like an example of 1 or 2 properties where you've been able to refinance and send a lot of the money back to investors.
Sure. So I bought a building, one of the first buildings I syndicated in 2010, was a 16-unit building in Panorama City. And we put in, I think, $450,000 or $475,000. I think we paid $1,750,000 for it. Very cheap at the time. So it was a 7.5 cap rate for those of you on the you're watching it.
Good deal.
Yeah, exactly. It was a great deal. So there is very few people in the market at that time buying. So prices actually dropped. This cycle, we're not really seeing prices drop that much.
Because interest rates are too high. Potentially, part of it.
I mean, people are buying with the higher interest rates and prices are not changing. There's just that much liquidity. In 2008 to 2010, when I started buying, there just wasn't a lot of liquidity for whatever reason in that cycle. So I bought this property, and basically within 5 years, maybe less, we refinanced and we pulled out, I think, all our money in the first refi.
All the initial down payment, the $475 or whatever you put in. So you pulled it all out.
So the investors got back their money. On a refinance, it's tax-free, so there's no taxes.
Right.
And then in this last 2 years, I refinanced again and pulled out another chunk of money. So part of that was used to fix up the building. We put on a new roof. It's actually 3 buildings, so we put on 3 new roofs. Redid the asphalt in the parking lot, 2 parking lots. Painted the property and did some other improvements to plumbing and some other stuff. And then they still got back
some of the money.
Yeah, and I've still got money in reserves in the account. So,
Right.
Buying real estate is like playing Monopoly. Like if you enjoyed the game of Monopoly, where you basically buy, you keep collecting money, you buy properties, then people pay rent when they land on it.
Yep.
You own it, you can mortgage it, you can go buy other properties. It's kind of like playing Monopoly, but
Right.
much more intense
Bigger scale.
Yeah. But the idea is basically you own buildings, you cash flow.
Right.
You refinance, you get more cash back, and then you reinvest all that
Right.
cash. And so you're investing, cash flowing, refinancing, buying. And you just keep doing it.
Keep moving the money around.
And over time, it grows. I mean, just like buying a stock, and maybe it splits and it has dividends and all that kind of stuff, but just a different business.
And to sum up your philosophy, Warren, is in terms of Monopoly, avoid Boardwalk and Park Place and maybe buy the railroads or some of the other properties, the B minus C plus properties. So that's where it looks good to have Boardwalk, but you're really going to make money in the other ones. That's sort of part of your philosophy about buying.
The guys that generally own the Class A buildings, they're like the big money guys. Mm-hmm. And that's, the money for those deals are coming from insurance companies, coming from Wall Street, coming from hedge funds, coming from the big players that want to own marquee. Like I own Century Towers or whatever it is, or whatever big investment you can think of in your city. So that's who's investing in those, and that's why they invest in those.
Right.
And also, they don't want to put out $25,000 checks. They're putting out $25 million checks.
Right.
Or $250 million checks, because they've got billions and billions to invest.
Sure.
So it's just a different scale. But
Wall Street buyer is a little different than Main Street. Probably what you're a little more Main Street. I'm a little more Main Street kind of guy. Well, listen, anyone that's got information or has questions for Warren, where can they check you out or get information?
They can look at my brokerage website, BurzakAdvisors.com, and there's information there that leads you to the syndication.
And they can talk to you about syndications and ask questions.
Yeah,
I'm sure people
happy to answer any questions. I have guys that are always starting out in the business, contacting me, kind of picking my brain. So happy to mentor and ask answer questions and that sort of stuff.
Cool. Thanks so much. Great episode. Obviously very interesting. Got from A to B, A to Z, I should say, in terms of real estate investing, commercial real estate investing, and hopefully you'll come back next time. We'll do it again. A lot more to talk about.
Anytime.
All right. Thanks, Warren.
Yeah. Thank you.